Hello everyone, welcome to the 157th episode of me learning how to trade in Forex. So in the last episode we went through the complexities of trading. Basically another aspect to think about when choosing the right product is how complex it is. So do you actually understand how the product that you chose works? If not, you might need to learn the ins and outs of the product before you add it to your strategy. So what seems to be simple, such as buying shares, can actually be really complicated if you add in all the other factors such as price charts and movements, historical and current financial data, relevant macroeconomic events, and any first-hand experience of the company's product. And yeah, so commodities also appear to be valued according to supply and demand. However, neither of these are constant. So production can occur at different price points, constantly changing the equation. And then we looked at what different factors contribute to the product's complexity and how that impacts the way you trade it. So we've got price, pretty simple, obvious one. So the first thing that comes to mind when you choose a product, you can usually find the trade's pricing and cost information on your deal ticket before you take a position. Some prices aren't easy to find, so particular metals such as rhodium, because it's just more difficult to find than other commodities, the price for it, and you might need to battle to get a live price for it. We've got also news and events, basically economic data releases and breaking headlines often contribute to volatility in specific markets affected by the event, and as we know, increased volatility could lead to an increase in risk. So you need to monitor not only the relevant price chart, but also any economic events that might cause the price to fluctuate. So in some cases, release about one market can also affect another. Right, so to stay on top of this, keep an eye out for economic calendars and business news sites. So the news is also unpredictable, and the resulting price fluctuation can be brief, increasing your risk. Yep. There's also no guarantee that the market will shift in the way suggested by an announcement. And then we've got derivatives. Basically, trading derivative products amplifies the complexity inherent in the market. This is because they derive their price from an underlying asset using different methods. So with products like spread bets and CFDs, price tries to mirror that of the underlying asset. And then we got, however, once we enter the realm of options, it gets trickier because they use complex mathematical formulas to determine the price of a single contract, and many of the inputs for the formula are hard to determine. And then we've got leverage. So leverage, as we learned before, leverage requires a relatively small input, which increasing the exposure to the market, which amplifies the potential profit or a loss in a trade. Explained by this nice diagram here. If the market is volatile, your position's value can change rapidly. So that speed means you might need to monitor it closely and act quickly, or have other risk management strategies in place. So that could include your stop losses and your guarantee stops, things like that. So how an instrument's complexity affects you. Deciding how much complexity you're comfortable with is part of your journey. So I guess the thing to take away here is start with something you're comfortable with, and then you can always build up as you go along. So as you, I guess, acquire more knowledge, experience and confidence over time, you can gradually add more complex instruments to your portfolio. You do not need leverage to be a successful trader. And yeah, so internet's full of videos, articles and other information can help you understand how a product works or where to find a broker that offers it. So lots of research basically. And then we went through the lesson summary. So at the end of the last video, we also went through the beginning for the impact of time, where we got up to the long, medium and short term investment time horizons, which is the notes we made here. So let's carry on with where we left off at. So, can separate them. So, investment time horizons. For the investment arm of your wealth building blueprints, you'll be looking to generate money that you only plan to use in the distant future. Here, you may decide to hold on to each of your investment for several years. You can separate them into three distinct categories: long, medium, and short term. These are based on your goals and can help you choose the right products to achieve them. So, short term, investment time horizon, what does that say? Potential return time. For long-term horizons, you can expect to hold investments for 10 to 20 years. So long-term horizons can expect to hold investments for 10 to 20 years. Perhaps longer. Or even longer. Typically, this includes retirement savings, as there's something you want to build well in advance. This includes retirement savings. You could opt for more conservative products like savings and money markets accounts and money market accounts here. However, even those won't guarantee that the value of your investment will rise. Because remember how we talked about, if the interest rate is lower than the rate of inflation, then although the numbers looks like they increase, however the value, the actual underlying value, is actually decreasing, or the buying power is actually decreasing. However, those don't guarantee the value of investment will rise. As you know, savings account might seem like a safe bet, but you could still end up with your investment decreasing in value. If the inflation rate rises beyond your interest rates, your money will lose value. Even though the physical amount is increasing, this is because it will grow too slowly to keep up with the price hikes for everything else. One way you could combat this is by expanding your portfolio to include other equities like stocks and bonds. So that's a really good advice here, although conservative products such as savings accounts exist. Those won't guarantee that the value of your investment will rise, as if the inflation rate is higher than your interest rate, your money will lose value. I can't type. Even though the physical amount is increasing. This is because it will be growing too slowly to keep up with the price hikes for everything else. To combat this, you can expand your portfolio to include other equities like stocks and bonds. If you're planning on investing for 3 to 10 years, you could consider your activities to be medium term. So medium term horizons. Medium term time horizons. Three to 10 years. For example, this might be the right course of action if you're saving up for your child's college fund. You could buy bonds and stocks to help you achieve this goal, as you can hold them long enough to benefit from the potential coupons, interest payments on bonds, or dividends. So could buy stocks and bonds to help you achieve this goal, as you can hold them long enough to benefit from potential coupons and dividends. Short-term time horizons. Short-term time horizons usually span less than 3 years. Usually are less than 3 years. You might be preparing to buy a new house or need to use a bond fund soon for another purchase. In this case, you may prefer to invest using products like short-term bonds so you can have a quicker access to your money. May prefer to invest in short-term bonds so you have quicker access to your money. Tough economic conditions may put pressure on a portfolio and decrease its chance of making profits. Tough economic conditions may put pressure on a portfolio and decrease its chance of making money. In some situations, the entire market could experience a downturn. However, this might not deter a long-term investor because hard times usually pass and give an investment portfolio a chance to recover. However, this won't deter a long-term investor, as hard times usually pass and give an investment portfolio a chance to recover. Did you know, as the early days of the COVID-19 pandemic illustrated, markets can be highly volatile. Some markets depreciated by over a third in a matter of weeks. Luckily, markets can recover, as we saw after the initial panic. It could take a few years to get back into a profitable position, but if your time horizon is long enough, you may find yourself in a position to benefit from that recovery. It's important to remember that sometimes individual shares can collapse and not recover. Remember that some shares can collapse and not recover. Having a diverse portfolio of assets across multiple or different sectors, geographies and shares is a common strategy to help you protect your investments. So diversify your portfolio. Trading time horizons. In contrast to long-term investors, traders tend to focus on the short-term performance of their position. Here, you could hold your positions for a few minutes or hours. However, you might keep a trade open for days or even months. It depends on several factors. Trading time horizon, investment time horizon. It looks to be smooth. Trading time looks a bit jaggedy. Firstly, you may want to make use of leveraged derivatives to amplify your potential gains over the short term. It could lead to higher losses than you'd incur if you'd enter the market without them, but having a quick exit strategy might help you minimize the effect of a losing trade. Remember, traders need to be on their toes, keeping a close eye on the trades and making quick decisions around whether to take profit or exit a losing position. Waiting a few days to see what happens can lead to serious losses or profitable trades becoming losers. Keeping a close eye on their trades and making a quick decision around whether to take a profit or losing position. So you need to be decisive, basically. Be decisive with your trades. If a trade hits a stop loss, stop, I guess. If a trade hits a stop loss, don't adjust it or anything like that. Just move on. If a trade hits a stop loss, accept the loss and move on. If a trade hits a take profit, don't be greedy for more. Secondly, you need to account for the cost of trading. Overnight funding fees may seem small, but given time, they'll start to pile up. These costs can add unnecessary pressure, so it might help to understand exactly how you'll be charged. Overnight funding fees may seem small at first. However, they add up over time. These costs can add unnecessary, that's not how I spell that, that's awful, unnecessary pressure. So, understand how you'll be charged is important. Okay. Finally, your trading style, which we covered in the earlier lesson, will also likely influence your time horizons. If you're a day trader or a scalper, you probably won't hold any positions beyond the end of the day. Trades like these are usually open and closed in a matter of seconds or minutes. Because you're aiming to profit from small market movements, leveraged products might help you maximize your potential profits. Don't forget they can also amplify any losses. On the other hand, swing, momentum and position traders can stay in the market for days, weeks or even months. If your style falls into any of these categories, you'll likely have longer term trading horizons. However, some derivatives might not suit you because of the overnight funding costs involved. Yep, so your trading style will also likely influence your time horizons. Yeah. Okay, the link between time and risk. If your time horizon is in the distant future, you're farther away from your liquidity. This means that there could be more opportunity costs and more time for the market to move against you. If your time horizon is in the distant future, you're farther away from your liquidity. So, this means that there could be more opportunity costs and more time for the market to move against you. So opportunity cost is the missing out on potential profits because you missed out on the opportunity to take the trade, right? Your time horizon is in the distant future. There could be more opportunity cost and more time for the market to move against. Meaning there could be more opportunity cost and more time for the markets to move against you. In other words, time can put distance between you and your money and might decrease its potential value. Time can put distance between you and your money and might decrease its potential value. Yep. The more time there is, the larger its effect could be on the value of your wealth. Time can decrease your investment's potential value. The more time there is, the larger its effect could be on the value of your wealth. How long you plan to hold a position can also help determine how much risk you accept. How long you plan to hold a position can also help determine how much risk you can accept. One argument is that the longer your time horizon, the more risk you can take on. The assumption is that you're better able to wait for a market to recover. How long you plan to hold a position for can also determine how much risk you can accept. There are two scenarios for this. First, the longer your time horizon is, the more risk you can take on, as there's the assumption that you're better able to wait for the market to recover. However, there's an opposing school of thought. Second, it states that if you're retired, you might be more open to taking on more risk, perhaps because you're more experienced or you have less need of secure funds for the future. So both of them are saying that you can take on more risk. So how is it opposing view though? If you're retired, you might be more open to taking on more risk. So they're both saying you can take on more risk though. So how is that opposing thoughts? I would have thought the second one would say like, because it's a longer time frame or time horizon, there's more chance of something going wrong, which increases the risk of your investment's value going down in the future. I thought that would be one of the scenarios, but I guess not. So the second one is like a what is it called? Like, oh, since I'm retired and I've got enough money just to live off of, I can stick more money into my investments because I've already got what I needed to live. So I might as well just try to gamble and see if I can dramatically increase the value of my investment, right? So you can take on more risk to see if I can get a bigger return on my investment. If you're retired, you might be open to taking on more risk. Okay, ultimately how much risk you take on is up to you. You can stick to products that seem more secure or use a range of different ones to meet your various financial needs. Ultimately, how much risk you take on is up to you. Remember, you can have varying closure dates across your trading investment positions. These influence how much time you can dedicate to monitoring your portfolio and positions as well. If you're investing for the long term, you can have a time horizon that spans decades. This could mean you're able to check your portfolio less frequently. In contrast, you might need to keep a much closer eye on your short-term trades. Price movements can occur in seconds, and your open positions could experience significant losses. If you don't have time to watch the market, you may prefer to opt in for investing, as it tends to be for the long term. You can have varying closure date for your investments. These influence how much time you can dedicate to monitoring your portfolio. These influence how much time you can dedicate to monitoring your portfolios. Long-term investment portfolios could mean you can check your portfolio less frequently. Short-term investment portfolios could mean you need to check your portfolio regularly, as price movements can occur in seconds. If you don't have time to watch the market, you may prefer to opt for investing, as it tends to be for the long term. As a summary, the time horizon of each of your trades and investments can differ depending on your goals. You can have multiple positions with varied time horizons. Product type, costs, and trading style can also influence how long you hold position. How much risk you take on is often related to the amount of time you're willing to wait for your return on investment. No product guarantees that you'll never experience a loss in value, as there's always some inherent risk in any trade or investment. A product type, costs, and trading style can influence how long you'll hold a position for. How much risk you take on is often related to the amount of time you're willing to wait for your return on investment. No product guarantees that you'll never experience a loss in value, as there's always some inherent risks in any trade or investment. Yep, cool. So, find the right product. Find the right product. Date is the 5th. There are many ways to interact with the markets and pursue your financial freedom. In this lesson, we'll cover different products available, their risks and benefits. Remember, the product you choose comes down to your personal circumstances. This includes your risk appetite, where you need to close your trade or sell your shares, and how much time you have on hand to monitor it. Investment products. If you're looking for long-term returns from a market, investment products may suit your strategy. They still carry market risk even though they're not leveraged. Different products. Different products you can include in your portfolio. Investment products. That's right, remember the products you choose comes down to your personal preference, circumstances, not preference. So this includes risk appetite, where you need to close your trade or sell your shares, when you need to close your position, and how much time you can dedicate to monitor it. Investment products. If you're looking for long-term returns from the market, investment products may suit your strategy. Long-term returns from the market. You can hold these for years on end as long as you're happy with the returns and the quality of what you own. Can hold these for years. Share dealing. This activity might be what you think of when the stock market first comes to mind. Share dealing refers to buying ownership in listed companies directly. Share dealing refers to buying ownership in listed companies directly. If you choose to use share dealing to build your wealth, you'll be the beneficial owner of the assets you buy. It also means you're eligible to receive dividends associated with the investment. Directly. So not through an exchange. Is that what they mean by directly? Not through an exchange. So from the companies themselves. The beneficial owner of the assets you buy, you'll be eligible to receive dividends associated with the investment. They're issued at the discretion of the company, so the company could choose to cease paying dividends. However, they're issued at the discretion of the company, which means they can choose to stop paying dividends. Some companies use their profits to buy back their own shares or invest them in new acquisitions instead. When markets are down, even the best performing shares in the world can come under pressure and decrease in value. However, quality shares can recover over time and might reward patient investors. When markets are down, even the best performing shares can experience pressure and decrease in value. However, quality shares can recover over time and might reward patient investors. Share dealing enables you to build your own diverse portfolio, buying stocks and companies that you think will increase in value over time. If you decide a share isn't doing well as you hoped, you can sell it and look for a better option. Unlike other trading products, investments accounts typically charge low or even no fees to hold your shares. If you do decide that a share isn't doing as well as you had hoped, you can sell it and look for a better option. Unlike other trading products, investments accounts typically charge low or even no fees to hold your shares. So, investment products typically charge low or even no fees to hold your shares. That's good news, because when you find a winning share, you might hold on to it for as long as you can. Most providers will, however, charge a commission when you buy and sell shares. Right, okay. The fee is usually like a one-time thing when you first purchase it. There's no like, what's it called? Overnight funding charges, like when you buy derivatives, is it that? There's overnight funding charges on some products. However, most providers will charge a commission when you buy and sell shares. Managed portfolios. These offer an alternative to buying individual shares. They're often managed by a broker, and the legwork of selecting shares and putting together a diversified portfolio is usually done for you. Right, okay, so investment products. Share dealing is when you do it yourself, so buying the shares yourself, so you choose which shares you want to buy and sell. Whereas portfolios are like the company, what is it called? A broker selects the shares to buy, and you just need to pay for it basically. So often managed by a broker who selects the shares for you and puts it together in a diversified portfolio. So bonds, commodities, stock A, stock B. Managed portfolios can be structured according to your risk profile. Managed portfolios can be structured according to your risk profile. So you can look for one that suits you. Usually bonds and commodities are also included in them, which can further diversify your portfolio. Usually bonds and commodities are also included in them. Because they're non-leveraged, you may assume that they only suit those who are more risk averse. However, managed portfolios can include riskier investments which increase the inherent liability. Managed port are non-leveraged. You may assume that they only suit those who are more risk averse. However, so risk averse meaning those who doesn't want to take on that much risk. However, managed portfolios can include riskier investments which increase the inherent liability. However, managed portfolios can include riskier investments. These might be a solid entry point into the markets, as they offer both intermediate or immediate diversification and expert management, all in one simple product. Do you know which shares to invest in? Are you sure you have enough time to monitor them all? By choosing a managed portfolio, a lot of the work is done for you. You can save your time and leave the diversification to the professionals. However, this isn't always a foolproof solution. As with all portfolios, they might see price weakness in the shorter term due to overall market conditions. Portfolio managers aren't immune to making bad investments either. They could select the wrong sectors or shares. Right, okay, so managed portfolios can see price weakness in the in the shorter term due to overall market conditions. Portfolio managers aren't immune to making bad decisions. Can also make bad decisions. Can also make bad investments. Can also make bad investments. They could select the wrong sectors or shares. I'm going to leave this episode here, so in the next video we're going to carry on going through the rest of the products which you can invest in to put into your portfolio. So yeah, we'll begin next lesson or next video with the exchange traded funds. So thank you all for watching, and I will see you guys in the next video. Bye bye.